Hope you all have had a great start to your week. I know it was kind of boring out there overall, but sometimes that's just how it is. And sometimes that's when the market's sort of consolidating and getting ready to do something interesting. So I think we do have some things to take a look at, particularly now that we're unclenched from gamma exposure in this post-OPEX environment. So let's fire this off here first with the risk disclosure. All trades and investments involve risk of financial loss. The value positions can go down as well as up. Past performance does not guarantee or predict future results. So with that out of the way, I wanted to quickly talk about some new features on our Discord because I'm really excited about some of the stuff I've been working on in the lab that is now available for all of our members on the Discord. One is the dynamic pivots for the S&P 500 and NASDAQ 100 futures contract. Those update throughout the trading session, both during regular trading hours in the US and throughout Globex. So those can be pretty helpful just to be able to have an idea as to where some actionable potential areas of support and resistance may exist. And that's derived from volume profile. Then we have round the clock streams of key markets. So that includes S&P, NASDAQ, gold, and oil around the clock, both the pivots and bookmap streams. And then we also have NVIDIA during regular trading hours and pre-market, post-market. And we've just added an aggressive absorption indicator in addition to the exhaustion indicator. So we have a couple of pretty cool proprietary features in our bookmap that don't exist anywhere else but the Discord. They're not on any kind of marketplace. It's really just here for our members at TraderAid. And then we have audio alerts for unusual events to include things like icebergs and stop runs that are big enough to be something that we should be concerned about. And that's for all of the markets we're tracking: S&P, NASDAQ, crude oil, and gold. And we also have alerts for things like an absorption event, an exhaustion event. Those also will come up with the audio alerts. And of course, we do have News Squawk from 6 a.m. to 6 p.m. Eastern as well. And then we have optimized option signals. So we're looking for these unusual flows that might be occurring in the options market. This is something that is now available on the signal stream. I've just tuned it up a bit so we can see a little further out in the expirations and some of the bigger sweeps and puts and calls that are worth noting. So let's take a quick look at some of these features. One of them is, of course, this dynamic ES pivots. This is all based off of volume profile. It's actually pretty cool the way we have this all set up. And this is just a snapshot of the chart that is streamed live. And so what you can see is we have some key pivots going into the overnight tomorrow: 57.93, 57.82.25, 57.73.75, 57.57.25, and 57.50. So those are levels you're welcome to write down. You can create a screenshot of this if you'd like. But the way I'd look at it is I'd start getting much more constructive on S&P futures above that 57.82.25 level. It was formidable resistance today. So I think if we do get a decent break above it, we can have some continuation to the upside. On the other side of it, I'd look below at that 57.57.25 area. And I'd say if we do make a meaningful push below there, I think we get some downside continuation. So that's what I'd be looking for in Globex and this overnight session based on our dynamic ES pivots. And if you're on the TraderAid Discord, all you have to do is tune into the stream and you can find those levels as they are continuously updated during trading hours. We also have the aggressive absorption indicator, and this can be helpful, especially if there's some degree of convergence, right? So maybe you see an absorption just around a key level. Maybe there's some options flow that's starting to build, somewhere that is close to proximity of that absorption that could suggest that there's a reversal, that it's going to go the other way in terms of ES. So these aggressive absorption indicators tend to happen when one side is coming in and basically saying, okay, enough, right? And in size enough that it catches the attention of the indicator. And we've added this on to S&P, NASDAQ, crude oil, and gold, as well as the exhaustion indicator. So you'll be able to see this and hear it when it fires off during the trading day as well. So it can help to get our attention to, okay, what's going on? Is this something important? And then we can monitor whether there's follow through and if there's some scalpable opportunity or even a longer term intraday opportunity from that absorption event. So just something that we've been working on that's finally here in beta. It's available on the Discord basically 23 hours a day, 6 days a week, again in S&P, NASDAQ, gold, and oil. So those are two pretty cool features that we're excited about of some of the ones that I've just reviewed. And of course, if you haven't seen the whole video or if you're not able to stay the whole time, a recording of this will be posted just a bit later tonight. Now let's move on to some charts. The NASDAQ is at a key inflection point. I think this is a pretty important level to be watching around 480, 487. And the reason I say that is we get right into a really, really low volume node above that. It's a pretty gappy chart. So it's got some kind of poor structure above there. If we do build above there, it can be a really rapid move higher. Otherwise, if we do get rejected here, and we start to pull below that next low volume node and into the point of control, I'd say we're actually probably going to start to continue to move sideways to lower. So the downward trend line and that 20-day moving average will be key levels to watch if we start to pull below the point of control here. But right now, we've built up from a higher low. We are above the point of control, that descending trend line in the 20-day. So the more we knock at this level of resistance, the more likely it is we eventually do break above. So we'll be watching this area pretty closely on Triple Q. Next up, we have the Russell 2000. I don't know if this is going to be something that is a bit more of looking ahead as to what we can expect from the NASDAQ or elsewhere, or if the Russell's just doing Russell things. But for now, the Russell has once again been rejected at this key level. It just cannot seem to get above 224.61. And so that's an area that I would watch pretty closely, because so far it's been an area where there just seems to be plenty of folks that want to cash out. They don't believe this thing is going to break out. And we've seen 3 days of selling in a row after hitting that level. So I think that's somewhat decisive that we're getting rejected here. We're also below that point of control. I'd look for support below at 218.49, then the 20-day, and then we have a pretty big level potentially below that around 206.98. Moving forward from there, we've got gold. Gold continues to look really good. It hit my target that I made early summer for $2,600 gold in September. We're there. We're basking in the glory of new all-time highs practically every day. We've had this really constructive stair-step pattern higher. So if you've listened to me talk about precious metals in the past, what I really don't like to see is when they just rocket and they don't really give us any kind of, room lower, like they just continue to go parabolic. That's always very concerning to me. So when we have something like that happen in gold, I'm not really a huge fan of it. I'm usually looking to get out of the way of that type of move because it typically tends to reverse pretty sharply. But on the other side of that, we have the opposite here. We have this constructive stair-step pattern. Positioning has not been blown out too aggressively to the long side of yet. And we have continuations of these flows in options. We have constructive flows in calls, in GLD, in SLV, in GDX, and a number of the leading mining companies. That tells me there's some larger players. These aren't just folks like us, retail players at home. There's some larger institutional flow coming into these precious metals ETFs, into some of the futures contracts, and into some of the miners and mining ETFs. So I think that also gives us a sense that there's a broader swath of investors who are under allocated this space, and they are still looking to build into that long positioning, which to me is very encouraging. That's exactly what we'd want to see in this type of environment, right? So the other thing that we can talk about with that is that Skew hasn't gotten blown out to the upside in GLD, SLV, GDX, or a lot of the miners. So it's still kind of neutral to bearish Skew, which gives you a sense that there's still room for these options flows and the underlying prices to grind higher, or net, there's still room for this market. It's not euphoric yet, right? You know what gold euphoria looks like. It looks like piles and piles and piles of call buying, blowing out Skew to the bullish side, and price action going parabolic. We're not even close. We're just sort of grinding higher. And gold is also a hedge against uncertainty. And that's one of the biggest roles that I think gold plays. It's not really an inflation hedge. It's more of an uncertainty hedge. And if you contextualize it that way, it makes a lot of sense why gold is grinding higher with inflation, the rate of change for inflation going lower, right? We've seen measures of CPI and PCE and PPI overall going lower. So it's not really hedging against inflation. It's hedging against a less certain world. And what I mean is What's going to happen in the US election and with fiscal and policy? What's going to happen with this Fed cutting cycle? Have they already gone too aggressive? What about the global rate cutting cycle? All these cutting cycles are bullish for precious metals, of course, because you're bringing down nominal and real rates, which makes them comparably more attractive than fixed income instruments, especially as a hedging vehicle. So you see folks rotating more and more into gold. I think that is something that continues. I'm still looking at $3,000 an ounce for gold in the first half of next year, possibly earlier at this rate. But remember, there's plenty of catalyst to the upside. The geopolitical risks are continuing to boil under the surface. We see that escalation between Israel and Lebanon. And then we also have what's going on in Eastern Europe between Russia and Ukraine. Those are also factors that are likely to continue to kind of give an implicit bid to gold. So I would just say in an environment of maximal uncertainty, precious metals can be a friend of one's portfolio. I tend to like to have 5 to 10% allocation in times like this, particularly when momentum is on our side. And if you think about it, there's really no other way to trade gold than momentum. You know, once you take away momentum, you don't really have a lot to look at. We don't get the same kind of supply and demand data because all the gold that's ever been mined in the world is still kind of out there in one form or another. Even a lot of the gold used for industrial purposes, as much as can be reclaimed is reclaimed, and what is lost is pretty minimal in compared to the grand scheme of how much gold is out there in physical form for investment and speculative purposes, right? So at the end of the day, constructive gold, also constructive silver, a little bit more skittish on silver, but I'm bullish of it. I just think that what's going on in gold has the world's attention, and rightfully so, whereas silver, part of that demand is driven by industrial demand. So you just need to be sort of cognizant that a lot of that's coming out of these emerging markets like China, and we still need to see that demand ramp up to see silver continue to grind higher. Next up, we have copper. This is another one that relies off industrial demand that does seem to be improving. We also saw short positioning in the physical commodity growing a lot. So we saw, basically positioning get well ahead of itself. We had copper kind of put in a constructive double bottom here, and COPEX followed that, and it's breaking out. So I really like COPEX. This is one we talked about on the Trader A Discord as copper was breaking out. It's continuing. And so I'm just had that gray arrow start from when we talked about putting the trade on as we're breaking above the 20 here. And we can see that move is continuing to build higher. I still remain constructive on copper. I'm sort of leery of it like I am silver. Like we could still see some weakness in China, which is the world's largest consumer of copper. They consume over half the world's copper. So it's something to be cognizant of. But for now, we have to respect the momentum. And with that in mind, I still think we have room just under $5 higher to about 48.54. And then I want to close out this position on global copper, or COPEX, the Global Copper Miners ETF. The next one we have here is AMD. And I see Johnny Dankseed here, so I know he's going to love this one. But I'm looking at AMD moving higher to about 174.64. It does have some resistance levels. They're noted on the chart. You're welcome to screenshot this for later. But I do think the breakout from that descending trend line is very bullish. We're starting to get closer to this low volume area, and that's where price can move very quickly. So I've been building into this long position as we're in this higher volume node, kind of consolidating. My risk is pretty well managed. I've got the 20-day moving average right below. But I think if we're able to push into that low volume node, basically above 162.13, that's where it's really going to start to move quickly, in my opinion, and more than likely to the upside. So constructive on AMD short term. We're coming up from a higher low, and it looks like we're about to make a higher high, kind of reversing the downtrend we saw earlier. Another one I really like here, and this pullback today had me adding more, is DigitalOcean. So we've been talking about this one since it was like $38 a share. It was on one of my models confirming a reversal. I also like the business model. It is a cloud hosting company. It targets small and medium-sized businesses and developers. They've got a cost advantage above some of the big boys like Amazon, Google, and Microsoft. And, overall, I've used their products before myself. So overall, I actually like the company, but I also really like the momentum. And if you zoom out DigitalOcean on a longer term chart, you can see what I mean. But in the near term, I think we have some support directly under us around 40.96, and then we have some resistance at 42.22 and 43.28 from that prior run. But overall, I'm still constructive on this one to about $48. That's what I'm looking for, managing risk with that 20-day moving average. And then there's Natty, and we talked about this on the Discord in the commodities room earlier. I like the seasonality on it. I like what's happening with storage. We'll look at those two charts in just a moment, but first, just the ETF here. It really feels like a reversal. The technicals are starting to shift the other way, and like we saw with AMD, where it's about to go into this lower volume node, natural gas is there. At least the ETF, there's this huge area of very low volume, and that's sort of that poor price structure where you could see an upward retrace quite quickly. So with UNG, I'm excited about the opportunity for this one to give us a little bit of a run from here. You know, maybe we get just under 20% under or around that in this rally. And the reason I say that is because what we're looking at is very constructive seasonality. And more importantly, storage is reverting closer to its long-term average. You don't want to see storage levels too high on any kind of commodity you're trading, because if storage isn't moving, there isn't the demand to really get price moving. So more often than not, when natural gas is well above its 5-year max range, it's usually not performing well. And this year was no exception to that, which, you know, that was one of the reasons that things were so soft into April. And then in April, when we saw it kind of flattening out, I put out a tweet that ended up being way more, I would say, ahead of things than I thought it would be. I was just sort of speculating that I thought the bottom was in. It ended up doubling from there. Now we've had a retrace, a big one. And this tells me it's a good time to look at natural gas. It's also a good time to look at FANG. Now, natural gas is very, very high beta. So it's not something that I would recommend putting in much size. Right? This is one of those real small positions because you almost have to have a ridiculously forgiving stop loss on natural gas, you know, to be able to stay in the trade and not get shaken out by the volatility. So that's one thing I would say for UNG is, you know, it's going to be a very small position. Like I wouldn't size it up to being more than maybe 2.5% of total portfolio liquidity. And that's if you're being aggressive. For FANG, I would go a little longer because it's not nearly as high beta as natural gas. But the reason I'd be careful with FANG is they do have some exposure to oil as well. And we know oil has been a bit treacherous lately. But overall, let's look at seasonality. You can see we're coming up on the second best month of the year, and that is October. 65% chance of upside with nearly 7% gains in that month averaged over the last 20 years. So it gives you a sense that October tends to be a decent time of year. Part of this has to do with hurricane season. So some of it is a little bit related to the potential for disrupted production. But the other side of it, and we do have, by the way, a storm starting to build that could hit Florida, Category 3, and we'll see what that may do to the Gulf. But the biggest question here is really, what do storage trends look like? Storms or not, do we start to see storage come down? Do we start to see demand build up? And I think that's going to be the biggest determinant of price action from here with Natty. Next up, we have the New York Stock Exchange demonstrating the broadening out of this rally. You can see September has been a month of much, much more new highs in the New York Stock Exchange than what we've seen for most of this year. And this is where the market is going. You'll notice the NASDAQ has been underperforming. The mega caps have been underperforming. They have not had an easy time over the last 2 months, but there's this broadening out. So it's not the usual suspects that are really carrying this market as much as some of the smaller sort of inglorious S&P 493. And I like to see that. This is constructive because it distributes the load across more stocks, right? It also tells us there are opportunities in some of these lesser loved areas of the market. And that's why I've been looking at things like global copper miners as an example, because they were pretty beaten down and pretty hated. And that's one of the reasons I think that reversal has been so powerful and probably still in its somewhat early stages because, you know, folks kind of threw in the towel on a lot of this stuff. And yet here it is, it's coming back when one side of the boat kind of gets lopsided. In this case, it was everyone not caring or hating copper. And then you have a meaningful reversal in price. You can get a pretty powerful, sort of counter reaction there. Now, one word of caution, though, even with this broadening out, is that we are starting to look a little stretched. If we look at the number of stocks in the New York Stock Exchange that are above, where we are, like the number of stocks above their 20-day moving average, you've got about 73.21% there. My top area, my threshold for this to say, okay, we're starting to get a bit stretched is 70. So we're not euphoric. We're not incredibly dangerously stretched, but we are stretched to a point where to see some consolidation or chop or maybe a move lower is becoming more likely. And the more we get stretched, like let's say we get up to the 80s, that's where I'd start to put out a more like red alert. We're starting to get really stretched. A pullback could be imminent. But right now it's at least kind of giving a glance to and saying, I'm not sure if I want to get too long of some of this stuff because, we're starting to see the market tell us it is getting a little stretched in the near term. Now, another area that's very interesting to watch is Skew. Last week, I put out a tweet talking about how Skew had reached an all-time high. So you can see on the chart going back to 2021, that last high was around 170.70, and recently it climbed above that level. Today we've pulled back to 165.75, but it's still quite stretched. And what that gives you a sense of is more people are deciding to hedge through the S&P 500 index and puts that are offered therewith because it is quite cheap. It's attractive from a cost of insurance perspective to hedge out some risk with S&P 500 options. But on the other side of it, it's also giving you a sense that this is a relatively well hedged market, right? So if you did have a big risk off catalyst, folks that have bought insurance don't necessarily need to puke up their long positions because they can cash in some of this insurance in the form of puts to make up for that downside. So that can be somewhat helpful in an environment, particularly like this, where liquidity is really low. The order book today in the S&P averaged below 40,000, and that's an environment where you can have bigger moves with less flow to cause them. So that means that if you're day trading or even if you're swing trading shorter time intervals across the broad market, there's a higher likelihood of normal levels of volume moving price more. There's a higher likelihood of slippage, especially during event volatility catalysts, like later in this week we get GDP, durables, a Powell speech, and PCE. So just be cautious with your position size. It usually means you have to use wider stops to stay in trades, which also means it pays to be more, a little bit more thoughtful about what trades one wants to put on in that environment. Now we are deeper in positive gamma territory. S&P ended up at about 57.19. So that puts us well above the gamma flip, which our naive model calculates at 56.44. And we can see interest in call exposure is building higher. So that's usually a good sign. You can see that big build up at 57.50 and then that smaller build up at 5,800. So that's just giving you a sense that post OPEX, now that we're sort of free to move about the cabin, so to speak, in these markets, we have interest building higher. Like 5.1 trillion of gamma rolled off last week on Friday, and we can see folks saying, okay, we still see some upside from here, right? We still see potentially maybe another 20 to 70 points of upside from here in the near term. And that's kind of what that position roll is giving us a sense of. So finally, it is, as I alluded to, a week with some important event volatility catalysts. Now, not much going on till Thursday, so maybe we don't get a lot of decisive price action until then. But Thursday morning is going to be a big one. We get durables, we get GDP growth, the final revisions for Q2, and we get Fed Chair Powell coming out and trying to sort of, with this whole parade of different Fed speakers this week, justify that jumbo cut last week and give us a sense as to where maybe things are going from here. Then on Friday, we get core PCE. I don't expect any major surprises there, but it is still a big event. Now for GDP and for durables and for PCE, because it is a measure of consumption, downside surprises could be seen as somewhat bearish. Right? We are in an environment where downside economic surprises are now bad news again because the market's sort of fully priced in a very aggressive Fed cutting cycle. The Fed's more or less confirmed the market's expectations. So the dot plot came out with 300 bips of cuts expected through the end of 2026. So that's a pretty aggressive cutting cycle. And so that means that, if we continue to get downside surprises, folks are likely going to be more concerned about the earnings impact from that. On the other side, positive GDP, if it comes up to the upside more, durables orders that surprise the upside, could be construed as bullish here. So I think bad news is bad news. Good news is good news. Obviously, we'll see what the market reaction is when the data comes out. But that's my initial thought looking at this from here. So now I want to go into Q&A. If anyone has any questions about anything at all that I've talked about, let me know. Or if you have chart requests or other things on your mind. I think that's going to wrap it up for us here with navigating the markets. I don't see any questions coming in. So either I covered everything or I put you all right to sleep. Either way, I hope you all have an awesome rest of your week. Be sure to tune in. We'll have some trading streams going on tomorrow at 9 a.m. I'll be doing a stream with Bookmap. Thursday at 9:30, I'll be covering the opening bell. And then on Friday around 8:30 a.m., Aisha and I will be covering GDP. And we'll be talking about some of the other economic data that's come out this week, like durables and PCE that are coming out basically Thursday and Friday. So we'll cover durables, PCE, and GDP on Friday morning, and we'll probably have some thoughts about Powell's speech if there was anything noteworthy in there as well. So appreciate you all as always. And if you have any questions that come up as you're watching this video later or that you think of later, feel free to let me know in the replies below or otherwise. Talk to you soon.